All right, so welcome back to Trading Simplified. I got a comment from a subscriber talking about this fund, the Fidelity Composite Index Fund, FNCMX. And it was during one of my videos for my growth index fund that I made a video on, FSPGX, just comparing and just saying, what about this one? Is it any better? So I just wanted to bring them up side by side just so you can kind of compare and see that they're very similar. And there's a few key differences that I would like to point out. And I do think that they're both good funds. I don't think it matters which one you invest in. But for me personally, just right off the bat, I would invest in the one that I made the video on, which is the Large Cap Growth Index Fund, the FSPGX, strictly because we're going to go over it, but because they pretty much invest in the very similar sectors and the expense ratio is a little bit lower for the FSPGX. But let's just break down this one so that we can see. So right on the left side of the screen, you have FNCMX, and this is the Nasdaq Composite Index Fund. Now, as you can see, when you compare it, the long term over 10 years, this has done good, 17%. And when you look at the information technology, this is where it's actually, where is the money being invested in this index fund? 43% is in technology, and then consumers 17%, and then communications 14%. Now I'm just highlighting those three because when you move over to the growth index fund, you can see that the information technology is pretty much the same. I mean, it's at 46%, so it's a 3% difference compared to this 44% here. And then this one's 18% and then 17%. So not much of a difference there. When you compare the expense ratios, you can see on fees and distributions, you can see that this one, the Nasdaq Fidelity Composite Index Fund, will charge you $2.90 per $1,000. So to me, right there, that's a big fee that I have to pay. And I'm going to show you another ETF that I would invest in instead of this one, which I still think is a very good one, don't get me wrong, but I think that you can get better if you want to really crunch the numbers and not pay higher fees and get pretty much the same exposure. Then you have, when you compare it to the FSPGX, you're only paying 35 cents per $1,000. Now that might not seem like a big difference, but when you finally get to like 100,000 into these index funds, and they're taking 35 cents per every $1,000 you have in it, it's not as much compared to $2.90 every $1,000 in it. So just to give a little reference, if you had $100,000 in it, let's say, every year, 2.9 times every 1,000 you have, you're paying bigger fees, like $2,900 every single year on it. So I wouldn't want to be paying those fees. I'd rather pay this. I'd pay $350 every 100,000 I have in it. So just a little reference for it. Overall, it has a little bit of diversification, but when I think about growth funds and I think about where they're going to go, and I just compare the composition to this one, they're pretty much very similar, except this one just gives a better rate. But I do always like to look at performance, and this one has been around longer. So that's the higher risk with the Fidelity Large Cap Growth Index Fund, is that it's not around as long. So you're actually just trusting that it's going to do better. So I have another window tab that I'm going to bring up, and it compares both of them actually. So let me just bring this up so you can see it. I'm just going to make this clear just so it's a little easier for us to see. So right here, I put in, you can compare them, and I put in the large cap growth, and then I put in the FNCMX. And you can compare both lines. So the dark blue, which is this one, is going to be this one, and it's been around since like 2012. So it's showing it here, the 10-year. And you can see the track record of where it's been and where it's gone now. And then when you do the video that I made with the FSPGX, you can see it only started in like mid 2016, 2017. But when you look at the composition of both, in my opinion, this is fine to see. You can see that there was a little more growth, but it took another couple of years, another 5 years for the large cap growth index to really start growing. But they're basically investing in pretty much the same companies. So it's kind of hard to compare that. And I'm just going to show you really quick, because when you go under composition on both, you're going to see that the companies they invest in are very similar. So look at the top 10 holdings. The top 10 holdings are both, look at this, 48% and 48%. Apple, Apple, Google, Google, Nvidia, Nvidia, Microsoft, Microsoft, Amazon, Amazon. So far, there's no differences between them. Facebook, Facebook, Tesla. The only difference here now is this growth fund, the FSPGX, invests differently in Visa, Home Depot, and Google's in there too. So Visa, Home Depot, while this one invests in the FNCMX, invests in Costco and AVGO. And I'll be honest, I don't even know what they do. I don't even know what AVGO is. And I'm sure they're very successful, and people probably will write on the comments like, I don't know them. But when you look at them, there's not much of a big difference. The only key difference that I see here is if you want more diversification and it makes you feel more comfortable and you're willing to pay the higher expense ratio, is that this Nasdaq Composite one invests in over 3,500 holdings. So I can see the point where the growth fund that I'm investing in only does 500 companies. And this is just a personality thing. I'd rather have less companies and more aggressive growth, meaning more volatile, so it can go up and down quicker. I'd rather have that with less companies. I don't want to invest in 3,500 companies because I don't believe that 3,500 companies are going to be successful. I'd rather just have the top 500 that whatever they pick, they're just going to put in there that are performing well. And that's just my own personal opinion. But if you need the diversification, that's fine, then go for it. But when you look at it, they're both in the United States, pretty much 99% and 97%. So the only diversification you're really getting is you might not be getting companies that are actually performing well out of 3,500 versus 504. But it's really up to your call. I personally believe I'm going to stick with this one up here, the one that I made the video on, the FSPGX. That's what I would like to invest in. But I mean, to each their own. Anybody, you can invest in whatever you want. But when I think about diversification, I think about what's my objective. My objective is to keep putting money in this over 30 years. And I'm looking at companies like Apple, Microsoft, Amazon, Tesla, Google, and I think they're going to be around forever. Do I want to individually invest in them? No, I don't want to just own shares of just Apple. God forbid they go out of business and my whole investment's gone. But if I invest in the whole portfolio and I have out of 500 companies, if one of them fails, they're just going to replace them with somebody else. So that makes me feel better and I can sleep at night knowing I'm investing in these instead of individual stocks long term. That's just my take on it. I think that this is a good index fund you can invest in. But personally, if I was going to invest in them, I wouldn't invest in this. I would invest in 1Q. And I'm going to show you why. Because the Nasdaq Composite Index, every time you buy it, you don't have the liquidity that you want. Meaning that you can't, if you want to sell the same day during market hours, you have to wait until 4 p.m. and you're subject to whatever the market does. For me, that's a big deal. I'd rather have the ability to sell out when I want to sell out. So I would invest in 1Q, the Composite Nasdaq Index Fund. And I'm just going to break down really quick let me just make this bigger. I think that's why it's affecting this. Hold on, here we go. Okay, so just looking at them, you can see that 1Q, which is what I just brought up, is an ETF, meaning that you can trade it like a stock pretty much, and you can sell it during market hours at any price immediately. You don't have to wait until 4 p.m. So when you buy index funds, you have to wait until 4 p.m. to buy them if you place an order to buy, or to sell them, you have to wait till the market closes. With 1Q, you're basically getting the same, I'm going to break it down, but you're getting the same investment as the previous index fund I was just showing you for a lesser expense ratio because it was 0.3 and this one's 0.21. And when you look at the top holdings, it's everything that they invest in. It's got the AVGO that it had the Cisco in it. And it's investing in 1,100 companies versus 3,500 companies from before. So I like that. And the thing about 1Q is the life of it, it has made, this is 1Q right here. Over the life of it, you would have made 27% already. Over 10 years, you made 17% on your money, a year over year, which is huge. That's great. It's a great return on investment. Right now, the Nasdaq's struggling, but I think these are good buys if you're a long-term outlook. And this is the chart for 1Q, just to break it down a little bit further. I mean, this is the last 5 years. I mean, it used to trade at $25, but it's been around forever, this guy. So it's been around since like 2012. So it started around the same time, Same growth, probably looks like a very similar chart, but the difference is you're going to have a lower expense ratio, so you're paying less fees. So in my opinion, if you want to own technology in Nasdaq, just own this, because you're going to pay less fees if you're comparing it to the other growth fund that we were, the FNCMX. And when you look at the composition, you can see that it's the same thing. It's all in North America, pretty much, the United States, because you can see it here, 96%. The expense ratio is good. It's all large cap growth stocks. So personally for me, I would buy 1Q instead of buying the FNCMX, because it's the same exact chart, very similar companies. You're just paying more to own it. So I'd rather just go with the lower expense ratio and go with 1Q instead. So I just want to give a quick recap because a subscriber reached out and just asked a question about it. I just want to give my opinion. I mean, if you like this, definitely go for it. And there's nothing wrong with it. They're all great investments. And the fact that you're buying these long term is a great investment, and you're going to make money on it in the future. As long as you hold it long term, it'll be fine. It just depends what you want to pay in expenses. For me, expenses is always the deal breaker. And I'm always looking for that, and I don't want to pay those big fees. So I hope this helps a little bit, just comparing a few index funds that you could invest in the long term. And if you like what I brought up, please subscribe and like the channel.